Soaring inflation and the latest interest rate hike will take its toll on South African consumers. According to research conducted in TransUnion's fourth quarter consumer pulse study, over 60% of consumers have been forced to cut down on spending. Around 30% of consumers say they're unable to pay their bills and loans in full. So those with bonds and vehicle finance are set to struggle even further as a result. Lee Naik, TransUnion CEO, joins us now to unpack this further. Thank you so much, Mr. Naik, for your time this evening. Despite tough economic times, consumer appetite for credit remained high, according to your latest Insights report. Do people not realize the cost of credit, or is it because of tough economic times that they simply can't avoid taking out loans?
I think the reality is that there's much desperation right now. As you can see from the latest increase in the 50 basis points, look at a typical consumer that's bought a car and bought a house. We found that a typical consumer would buy a R1 million house and a 350,000 Rand car. That's going to cost them 430 Rand a month in additional installments. So the reality is these 9 successive increases, Andy, have put pressure on the consumer. So here's an important point. The biggest increase in origination of credit products is actually coming from the Gen Z group, which is up until the age of 26 years. These are the youngsters that actually are unemployed and are desperate to access credit. And what we find is that the credit products they're going after are the ones that are actually unsecured, so typically personal loans and utilizing the credit card just to get the liquidity that they need to live their lives. So it's difficult to live right now. Household income's under pressure, and the only vice they have is to turn to credit cards and to some of the other products like personal loans.
So South Africa is not really a nation well known for its culture of saving. How are we with paying back debt on credit cards?
We found in our Q4 data, when compared to the previous year, was actually there's a significant improvement in what we call severe delinquencies. So severe delinquencies are people that aren't paying their accounts for 3 months or more. We actually found that actually is improving. So what we can see in the data is that people realize that we are in a tough situation. Even though there's a cohort of people that are looking for more credit, there are some people that are deleveraging from credit and making better choices on paying down their debt and also deferring purchases as opposed to taking on higher interest debt facilities.
In terms of looking at what people are using credit for, do we have statistics on whether they're using credit to pay off other existing loans, or whether that's merely in terms of servicing the cost of living, to pay things like rent, cell phone bills, food, all that kind of thing?
Our data says it's a combination of the two, but by and large, people are looking for liquidity just to go through their normal day-to-day living. What we found in the data is that some purchases have seen a significant cutback. In fact, in the last 3 months, there's been a cutback on what we call discretionary spending. So all the way from cutting back on internet services or cell phones, or even eating out with your families, the focus is on basic living day to day. So one part is on servicing your debt, just to stay out of trouble with your lenders, but equally so just to maintain your day-to-day requirements, from milk and bread to transport. These are all being taken out of higher interest credit products.
In terms of servicing debt amid this interest rate pressure, are we also seeing financial institutions coming to the party, being more amenable to repayment agreements that might need to change as consumers find themselves under more and more pressure and perhaps unable to make the required payments?
I think that lenders are vehemently aware that it is tough right now for the consumers. As I mentioned earlier, about the impact of just the last rate cut. But if you compare our data from January 2020, the average consumer with a R1 million home loan and a 350,000 Rand car is paying well over 3,000 Rand more in their installments. So we know it's tough. What I mentioned earlier was that there is a demand from the younger population, what we call Gen Z, for credit products. But banks have actually been quite averse to extending high amounts of money. So what we call the outstanding balance has only marginally increased. And that tells us that banks are vehemently aware of the tough conditions, and they won't extend credit to consumers that aren't able to pay their accounts on time.
What are we looking to or expecting to see in the next quarter in terms of further interest rate pressures and the likely impact on spending?
The Reserve Bank governor was quite clear yesterday that he can't actually call the end of the cycle of interest rates going up. What he has said is they will try to protect and drive the inflation rate within the target range of 3 to 6%. What we can see, just given the global market on the macro side, is that there will be pressure to keep us within the target inflation rate. And even though he wants us to get to the bottom of the range, which is 3%, it'll take us some time to get there. There's a likelihood that interest rates may still be a lever they use to keep inflation within the target range. And what that does, however, mean only is that consumers will come under pressure and their disposable income will be stretched even further. All that consumers can, in fact, do right now is start to consider how they go about their purchases. And what I tell our consumers is, think about your needs in terms of what I want versus what I need. And those judicious choices will help you in the immediate short term.
If consumers are able, and they're part of the lucky few who are able to pay off debt in this difficult period, what kind of savings would that ultimately get them if they're able to do that, as opposed to continuing with the regular down payments? I mean, for instance, someone comes into a small sum of cash, gives them some liquidity, some freedom to settle debts.
One of the advice that we've given most savings professionals would say the same is that you've got to service down your high level of accounts that you have. So most consumers try to concurrently save in a separate facility when you have outstanding debt to a lender, whether it's a bank or a non-bank lender. Our advice is quite simple. Start with your highest interest-bearing debt and pay that down. You should only start considering putting money into a savings account when it can actually get you as much interest or more as the debt that you have. But my biggest advice is that given the high level of indebtedness in South Africa, is pay down the debt and don't rush to actually find ways to save. We'd rather look to you talking to your bank or your lender to consolidate your debt products into having a better product that gives you better interest rate conditions versus keeping your money aside to have a concurrent savings product.
Well, thank you so much for speaking to us. That was Lee Naik, TransUnion CEO, giving us some indication of what the picture looks like in terms of consumer pressures amid interest rate hikes.